Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about how inflation is finally easing, how bad 2022 actually was for investing, and today's bank earnings. Before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Yesterday's inflation number shows the inflation is easing. What's your take on how this affects the markets?
Hey, good morning, everybody, and welcome back to the morning show. We've been kind of wrapping up some end of quarter / end of year stuff, which is a very busy time. Went through all the billing cycle, and we are back in action. Also, Allison's back at Alabama, so we should be on a regular schedule starting today and on into next week. So now back to this question. Inflation easing. So we got the print yesterday, right, which was 0.1% reduction in the inflation number. Well, that was what was expected. So you get into this conundrum of, is good news or is good news bad news because it wasn't good enough? And that's what the market struggled with yesterday. I'm going to pull up the S&P 500 here in the 5-day chart. So here we go. As that pulls up, you can see yesterday we're kind of all over the map, right? So this is yesterday right here. And initially, when the number came out, you think, okay, well, it's what was expected and it's a decrease. That's good news. You would think the market would celebrate that. However, is it good enough news? If it's not good enough, then the market can interpret it as bad news. So that's where if you hear this nonsense about good news is bad news, blah, blah, blah on CNBC, that's what they're talking about. So 0.1% was a decrease, but was it enough? And if it's not enough, that means it's okay, it's what was expected. But now the market thinks now the Fed is going to have to stay aggressive versus kind of dialing back the rate raises there. So we shall see. I thought it was good news. It was exactly what we were expecting, and it is on a trend towards a healthier place with inflation decreasing. So going to pull up the 1 month. That does not look like a 1 month version there, so we may have to bail on this. But if you know let's try the NASDAQ charts while we're here. If you know how 2023 started, we had a bad first day, and then since then it's been up. NASDAQ is already up 5% on the year. So overall, the markets are up on the year, largely coming off of just a bad year. So overall, I think this will continue as far as, today looks like it's going to be a red day. But overall, I think your market is going to trend higher as the inflation truly eases, even if it's at a slower pace.
Next, the statistics are out confirming that 2022 was the worst year for investing since 2008. How bad was it historically?
Yeah, well, this is one of those things. I don't want to tell you what you already know because you lived through it. But here's why I want you to keep this in perspective. 2022 was a tough year, a terrible year for investing. You've already been through that journey, though. So as you take this ride of investing over a lifetime, you're going to see good times and bad. And you have to realize that when it's the worst, it's the darkest before dawn kind of thing, is that when that time in which it seems really bad is when people capitulate, right? They just go all to cash and then they leave the market and they're done, and they say, well, the whole thing's a casino, and you've heard the spiel over and over. Well, you've already been through the bad part, so you can relish in the fact that when markets are that bad, the reversion to the mean, right? They go so far down that's the time to buy, actually. And that we've been a net buyer here over the past couple weeks. So, how bad was it? And to put it in perspective, well, here's the stock market chart. I thought this was interesting. You may have to pause this to be able to kind of really look at these. But if this is the rate of returns across the bottom, and then it's the years, and this is the last 97 years for the stock market. So think equities, right? So here's your 2022 is all the way over in that left side in purple there. See if I can highlight it. Maybe. Nope, that did not work. But there's been only 4 years that were worse than 2022 in the past 100 years. That's how bad it was. We executed our bear market strategy. We tried to less than the overall market and you hold your best to breed through. But just realize that's where we are on the spectrum of things. And, when the stock market's down, I threw these numbers out at the end of the year last year. There's an 80+% chance, historically, that the next year is up. And then the average return of that is 14%. We're already 5% in the green. It doesn't seem like it, but yeah, we're 5% up in 2023 already. Not counting today. We'll see what today holds. But this is just the stock market. Look at this chart. This is really why I wanted to show everybody is when we talk about the death of the 60/40 portfolio and the need for direct indexing. And if you're not eye rolling right now as to, oh man, he's going to talk, in the weeds, but this is why the 60/40 did not work and you had to get out of it last year. Look at where historically the bond market over the last 97 years, it's that purple number there on the left, all the way by itself. It was the worst year ever in the past 97 years for bonds. That's because the Fed raised interest rates faster than they ever have before. And unbelievably, this was only as bad as it got, right? The worst in 97 years, but you could see that bonds, even investment grade bonds, were down 20+%, which you just don't see that right now. That mostly my bond investing is through individual bonds. So those you simply hold through. It doesn't matter what their price is during the ride because you're holding them to maturity and then you get your money back. But just realize that's how bad 2022 was historically. I mean, it was just really, really bad. But the good news is when you look at our economy, the economy is not broken. It's just we have inflation. Things are more expensive. So all in all, to kind of summarize 2022, it was that bad, which sets us up for, when things are that bad, you're further down on the coaster it's a lot easier for it to move up into 2023.
Last, bank earnings are out this morning and the market is selling off. What does this mean for financials in 2023?
Well, financials is one of the themes. If you caught my January 5th investment advisory board presentation, it's one of those things that is going to be an investable theme later this year, right? So we have to get more clarity on, if we're going to have a recession. We likely are, but how bad is it going to be? So we had the bank earnings out this morning. They were obviously not as good as we'd hoped, and most of them are selling off. However, it's really not what has happened. It's what people expect to happen. And people are so negative on the recession that's coming that I think they're caught up in the hyperbole, if you will. When you think JP Morgan and Jamie Dimon, the CEO, again, the longest tenured CEO in the financial firms, the big financial firms, he was in the chair through the crisis of 2007 through 2009. Last year he was painting a gloom and doom picture of an economic hurricane, was the term he used, was hurricane. Now it's down here in this article, mild recession. Is the central case. So people are starting to walk back, from the how bad is it going to be? Well, look around. I mean, recession means huge unemployment. There's just not huge unemployment right now. So therefore, is it a recession? Are we going to be in a recession? Well, if we're fully employed, it's hard to say that we're in a recession if everybody's working. There are layoffs going on around out there. A lot of those are preemptive layoffs for companies thinking that the worst is coming. But it still hasn't, even with the layoffs, it has not caused an unemployment problem. So that'll be the question for 23 is, does it, and is there a recession, and how bad is it going to be? But it was nice to see at least one of the major financial firms say that it's not going to be nearly as bad as we thought. But overall, you got JP Morgan down this morning 2%, Wells Fargo down 2%, Bank of America was out. So the numbers were strong. The banks are healthy, however, selling off due to the expectations. Also, Delta out this morning. Beat earnings and beat revenue, down 5%. That, well, a lot of that's, FAA issues, and we just had the Southwest implosion, and people are starting to, lose their trust a little bit in the airlines. But yeah, not one of my favorite places to invest, but it would certainly be challenged in a recessionary environment. So overall, to wrap it up with the financials, I do like them. I don't like them yet. So it's kind of, if you hold JP Morgan or Bank of America or the XLF, we're just holding through this. But there's going to be a point to where we add more when we switch back towards more aggressive stance. And financials, I think, will be one of the success stories for the second half of 2023.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.